If your personal name is attached to your assets, you don't own them. You're renting them from risk. And in today's legal environment, exposure is more expensive than failure. The difference between temporary income and generational wealth is structure. Let's talk about the wealth shield. In 2026, one lawsuit, one contract mistake, one personal liability issue can legally separate you from everything you've built. Not because your business failed, but because your protection failed. And if your name is directly attached to your assets right now, you are financially exposed. Today, I'm going to show you how serious wealth builders protect everything they create legally, strategically, and quietly. Not to hide, not to evade, but to endure. We live in the most searchable era in human history. Your name can be typed into a database in seconds. Business registrations, property titles, litigation history, tax records, corporate structures. Everything leaves a trail. Now ask yourself, if someone wanted to target you, how difficult would it be to map your assets? That's the question high-level operators ask before they scale. Because lawsuits don't always start with wrongdoing. They start with visibility. The more successful you become, the more attractive you are, not just to clients, but to opportunists. And opportunists don't attack emotion, they attack structure. If your structure is weak, your success is temporary. An LLC is not a badge of entrepreneurship. It is a liability firewall. But here's the truth most business owners ignore. The LLC only works if you respect the separation. If your business makes money, and you spend it directly from the same account, you've already compromised your protection. If contracts are signed personally, you've already created exposure. If documentation is casual, you've already weakened the wall. Courts don't care what you intended. They care about structure. And when structure collapses, they pierce the corporate veil. That means the shield dissolves. And when the shield dissolves, personal assets become reachable. Homes, savings, investments, retirement accounts in some cases. This is not dramatic. It's procedural. High-income earners lose money not because they failed, but because they were informal. Informality is expensive. Real wealth builders operate through entities. The business earns. The business signs. The business carries liability. You receive compensation strategically. Clean payroll. Clean distributions. Clean documentation. You don't move money emotionally. You move it intentionally. Every dollar has a category. Every transaction has a record. Why? Because structure is stronger than memory. When your finances are clean, your defense is strong. And strong defense allows aggressive offense. You cannot scale safely without separation. Now we go where serious operators live. Ownership structuring. Some people casually refer to this as ghost ownership. Let's clarify. It is not hiding income. It is not evasion. It is layered ownership. For example, an LLC owns your operating business. A holding company owns that LLC. A trust may own the holding company. You maintain control, but your personal name is not directly attached to high-value assets in public databases. This accomplishes three things: privacy, insulation, negotiation leverage. Because when someone evaluates whether to pursue litigation, they calculate effort versus reward. If the structure is layered, documented, and professionally built, you are less attractive. And reduced attraction reduces conflict. Wealthy families have done this for generations. Not because they are paranoid, because they are strategic. But hear this clearly. Improper structuring can create more risk than protection. This is not a DIY project. This is architecture, and architecture requires engineers, asset protection attorneys, tax strategists, estate planners. The shield must be legal, or it will fail when tested. Here is what mature wealth builders are doing now. They separate operating companies from asset holding companies. They avoid mixing personal and business capital. They formalize contracts even with friends. They review liability insurance coverage annually. They update estate plans as assets grow. They think in decades, not quarters. Because in 2026, risk is evolving. Digital reputation risk, cross-border taxation, increased litigation culture, economic volatility. You cannot control the environment, but you can control your structure. And structure determines survivability. There is a psychological shift that happens when you know you're shielded. You operate differently. You negotiate differently. You invest differently because fear no longer dictates decisions. Confidence does. True financial maturity is not about making your first million. It's about protecting your fifth. That's where separation between amateurs and architects becomes obvious. Amateurs chase income. Architects build systems. and systems survive storms. In 2026, your digital footprint is as valuable as your bank account. Every online registration, every business profile, every social post leaves a trace. Opportunists, competitors, even hackers, they study these traces to find vulnerabilities. High-level wealth builders don't just operate offline. They manage visibility, separate emails, separate domains, control disclosures. Because exposure isn't just physical, it's digital. And digital exposure can destroy what took years to build silently, efficiently, legally. Wealth isn't just about today. It's about survival. Your children, your heirs, your family, they inherit both assets and vulnerability. The smartest protect wealth across generations. Layered LLCs, trusts, holding companies. Not to complicate life, but to safeguard it. Your shield today becomes their freedom tomorrow. Money without protection dies with its owner. True legacy requires a system. High earners don't chase returns blindly. Every investment is evaluated for both upside and exposure. They diversify with intention. Holding companies separate risky ventures. Legal entities shield personal assets. Structured ownership limits liability. When wealth grows inside a shielded structure, fear doesn't control decisions. You can scale aggressively without magnifying vulnerability. Because structure isn't limitation, it's power. You didn't work this hard to leave it exposed. You didn't take risks to watch them unravel. 2026 will reward disciplined builders. Not those who earn the most, but those whose assets survive storms. And when you combine foresight, structure, and execution, you don't just make money. You make history. You didn't build cash flow to leave it unstructured. You didn't accumulate assets to leave them legally naked. You didn't master income generation to ignore capital preservation. High earners focus on revenue. Wealth architects focus on risk-adjusted survivability. That's the difference. When your entities are layered, when your liability is insulated, when your ownership is structured, you gain something more valuable than income. You gain strategic confidence. And strategic confidence compounds. In 2026, the real winners won't just be those who scale fastest. They'll be the ones whose balance sheets survive pressure. Because money made is temporary. Money protected is generational. Build income. But build structure first. That's how wealth becomes legacy.